Firstly, superannuation is money put aside by your employer from your income into a retirement fund. It could be of your choice or your employer's choice, and you can access this money when you reach a retirement age, generally after the age of 60. As of 1 July 2024, the amount of money that you'll be investing of your income is 11.5%. So it makes sense to pay a lot of attention to what you're investing your superannuation into, as it's your money. Historically, 27% of the time, there has been negative years. So out of 10 years, 3 years would have negative years. That's why you need to have more than 10 years to have an aggressive approach when it comes to superannuation. You would want to be defensive if you're close to retirement and aggressive if you have a long period of time. Along the way, there will be crashes in the stock market. However, we're going to be taking into account in our long-term approach. 27% of the time, there will be negative years. Your superannuation, they generally have the same investments and portfolios. Take, for example, Australian Super, HESTA, and Vision Super. They pretty much all have the balanced and the high growth options and so forth.
But what is in this portfolio?
You've got 17.5% in T-bills amortized over the fiscal year.
We're going to be looking at Australian Super. These are the portfolios. As you can see, they more or less invest in the same things. It's just the weightings of growth and defensive assets that change. Growth assets are things like shares, and defensive assets are things like interest and cash. For the purposes of this video, I'm going to compare two of the portfolios, high growth and balanced, and look at the growth assets and defensive assets. For example, Australian shares, 28% in high growth and balanced is 21.5%. So they invest in the same thing. What I look for when I'm investing is, does these investments beat normal inflation, which is 2 to 3% historically? Because if it does not beat inflation, your money is not really working for you. In the last 20 or so years, inflation, the target range is 2 to 3%. High growth portfolio has an 8.95% return over a 5-year period on average. One thing I like to outline about the balanced portfolio is how much money you have in credit, fixed interest and cash. You would see a large portion of your portfolio is in these defensive assets, which these are the things that you would have if you are close to retirement, not when you have a long time till retirement. Balanced portfolio, on average per annum, 8.05% over a 5-year period. Australian shares return over a 5-year and on average period is 10.67% per annum. As you can see, quite high. International shares, again, quite high. These are your growth assets in your portfolio that are going to bring you more return in the long term. And fixed interest, about 0.91% per annum. You would have growth assets if you have a long time till retirement, and you will have defensive assets if you're close to retirement. A conditional portfolio is if the interest rates were really high, you'd go for this index diversified portfolio, which has a higher amount in fixed interest. But again, historic after 2010 especially, interest rates haven't been too high to have a big portion in your portfolio. And then we have cash, which brings hardly any return, doesn't beat inflation, 1.49% per annum over a 5-year period. You might as well just throw your money into the trash. Comparing these in a long-term portfolio on this bar chart, on the highlighted top left, 10 years, the average return of high growth was 9.48% and balanced 7.65% over a 10-year period. And I'm going to highlight in future videos the importance of percentages in the long term. Now, I went one step further and I went and found the returns of high growth balanced international shares and Australian shares for the last 23 years. And if you had hypothetically invested into each of these, by the end of the 23 years, high growth would have been $53,535, balance would have been $51,531, and international shares would have actually been $28,771, and Australian shares performed the best at close to 70,000 Australian dollars. And why did this happen? That's because in the time frame, interest rates were much higher at the year 2000. And on top of this, there was a dot-com bubble from the year 2000 to 2003. And then there was also the global financial crisis. That's why shares did not perform as well. But Australian shares did do impressive returns over this time period. That's why it's important to have a diversified portfolio, not just focus on the last 5 or 10 years and think of what is going to happen in 20 years. And so that's why we'd have a big balance of Australian shares and big balance of international shares in our portfolio. Things like infrastructure are things that I'd love to have in my portfolio, but unfortunately they don't allow you to choose this in the DIY mix. One other thing is these portfolios are not static. They actually do change depending on market conditions, and you can see high growth as of July 2023 and as of December 2023, the percentages did change. Moving on, these are your options. So you can choose from the pre-mixed options and DIY mix, and you can actually mix these together as well. So you don't have to go 100% in Australian shares or 100% in balanced portfolio. You can have a mix. So my first option idea would be just to have a simple set and forget. I'll invest into 100% high growth and I would not do anything and just leave it for the long term. And this portfolio has automated rebalancing depending on market conditions, and it has a mix of growth assets and defensive assets, and you can look between 9 to 10% return per annum over a long period of time. Now the second option, which I personally have my portfolio in this option, is I have a mixed portfolio of high growth Australian shares and international shares. 30% in high growth, 31% in Australian shares, and 39% in international shares. This ensures I always have a big portion in growth assets and a small portion in the defensive assets. You're more likely to have higher drawdowns, but you're also more likely to have higher returns over the years. For example, I'll show you what my portfolio did in the last 1 year. So I did a return of 16%, while in the last 1 year, high growth was 12.27% for the year. So I will be losing more in a downturn. However, I'll be losing from profit and I'll still be in front in the long term. That's why it's important to do this while you have a lot of time till retirement. One other thing I'm going to do for you guys is Australian Super has a member direct option where you can actually choose your own ETFs and what you want to invest in. So I am going to convert my balance into member direct, and I'm going to show you my portfolio in the future videos and what I aim to do there. So the portfolio is riding conservative or high growth does not make them more or less risky. What's really important here is the amount of time you have till retirement, which will dictate whether you go for more growth or more defensive assets. Also, the rate of return is also a big part of the overall strategy, as that will determine whether you have a very comfortable retirement or a not so comfortable retirement. And in the future videos, I'm going to cover the overall strategy. In this video, it was just looking at the returns of the different portfolios and what they invest in inside your superannuation. So don't forget to like, comment, and subscribe to be notified for future videos.